Hello. In this session, we'll be doing some numericals related to marginal costing. Let us start with the first example here. ABC incurs fixed cost of 3 lakh rupees per annum. It is a single product company with annual sales budgeted at 70,000 units at a sales price of 300 per unit. Variable costs are 285 per unit. The company is deliberating upon an increase in the selling price of the product to 350 rupees per unit. This shall be required in order to improve the quality of the product. It is anticipated that despite the increase in the selling price, sales volume shall remain unaffected. However, the fixed cost shall increase to 450,000 rupees per annum and the variable cost to 330. So now let us, you are required to draw a profit volume graph and determine the break-even point. So first let us start with the basics, wherein the selling price so this is your current situation and this is your proposed situation. The current selling price is 300, proposed is 350. Variable cost, currently it is 285 and proposed situation variable cost is 330. Therefore, the contribution per unit is given to will be calculated as selling price minus variable cost. So that will be 15 current situation, 20 in the proposed situation. The fixed cost in this case is 3 lakh rupees and 4 lakh rupees, 4,50,000 rupees respectively. Therefore, break-even point, which in units is calculated as fixed cost upon contribution per unit. So it will be 3 lakhs divided by 15 and 4,50,000 divided by 20. So BEP in units in this case will be 20,000 units and here it will be 22,500 units. Right? They have also, it is very easy to plot the graph as you are well aware. I'll give you a quick description of how it is supposed to be done. On the x-axis, you will have units. On the y-axis, you will have rupees. Your starting point for the total cost would be from the point of fixed cost, because even if you do not manufacture anything, you will still incur the fixed cost. So in the current situation, 3 lakhs would be the starting point for your total cost. So it will go from here. If you are not manufacturing anything or not selling anything, your sales revenue is going to be 0. The point where the sales will intersect with the total cost, and this is the sales, is your BEP in units. So in the current scenario, it would be 20,000. So this is how you are expected to draw the graph. But they have also asked us to comment on it. Now let us also find a point or sales at which what is known as indifference point. That means the profit under both the situations would be the same. So let us assume, let X be the number of units at which profit under both the situations would be the same. That would be the point of indifference. So currently your contribution is 15 rupees per unit. Total contribution would be 15 into X units, 15X, minus the fixed cost of 3 lakh rupees will give you the profit. Now this profit should be the same under both scenarios. In the second scenario, the contribution is 20 per unit. Total contribution would be 20X minus the fixed cost, which is 4,50,000. So when you solve this, you will get 5x is equal to 1,50,000 and therefore x would be equal to 30,000. So this is known as point of indifference. That is, when you sell 30,000 units, the profits under both the scenarios would be the same. Right? So this is what is expected here, or you should be able to explain this. Going on to the next question here. Two businesses, AB and CD Limited, sell the same type of product in the same market. Their budgeted profit and loss accounts for the year ending 30th June are as follows. So sales, variable cost, fixed cost is given for both the things. You are required to calculate the BEP of each business and state which business is likely to earn greater profits in the conditions of heavy demand for the product, low demand for the product. Now let us calculate here A, B and C, D, right? So when you're doing this, start with the sales, which is 1,50,000. 1,50,000, right? Variable cost here is 1,20,000. Here it is 1 lakh. Therefore, contribution is going to be 30,000 and 50,000. Now in this case, we'll be calculating the PV ratio or CS ratio, profit volume ratio, or which is also known as contribution to sales ratio. So in this case, the contribution to sales ratio or the PV ratio is going to be 30,000 divided by the sales, which is 1,50,000 into 100. It's to get it into percentage, right? So this will give you 20%. Correct me if I'm wrong. Yeah. And in this case, it would be 50,000 upon 1,50,000 into 100, right? So this will give you 33.33%, right? So in this case, the contribution is PV ratio for B is more, right? So where the demand for the product is more, the product CD would be more suitable since the PV ratio is higher. So you should be able to interpret the PV ratio as well. Higher the PV ratio, more profits it would earn, because the BEP would be less. Now in this case, BEP is calculated. This will be BEP in rupees, sales volume, right? So in this case, it is calculated as fixed cost upon the PV ratio. Now here the fixed cost is 15,000 and here it is 35,000. So now if we want to calculate in this case, the PV ratio will be 15,000 upon 20%. So you should have a sales volume of 15,000. Give me one sec. Divided by 20%. So 75,000 sales volume rupees will give you the BEP. For CD, your fixed cost is 35,000 divided by 33.33. So here it is going to be, BEP is going to be 1,05,000 approximately. So heavy demand for the product and low demand for the product. If the demand is low, it's better to calculate, manufacture AB. If the demand is high, you can go for CD. Going on to the next illustration here. A factory is currently working 40% capacity and produces 10,000 units. At 50%, the selling price falls by 3%. At 90% capacity, the selling price falls by 5%, accompanied by a similar fall in the prices of raw material. Estimate the profit of the company at 50% and 90% capacity production. The cost present per unit is material 10, labor 3, overheads is 5, where 60% is fixed. The selling price per unit is 20 rupees, right? So here we make a tabular form wherein we will do the calculation for 40%, 50% and 90%, right? So the selling price is going to be the same. Selling price per unit is going to be 20. So before we do the selling price, let us first also give me one sec. Let me erase this. Let us first calculate the number of units, right? So at 40% capacity, it is 10,000 units. So units at 40% it is 10,000 units. So for 50% it would be how much? Let us calculate that. So simple, 10,000 into 50 divided by 40. So it will be 12,500 units. For 90% capacity, it would be 10,000 into 90 divided by 40. So approximately 22,500 units. Right? Now, let us look at each situation. Factory is currently selling 40% capacity. At 50%, the selling price falls by 3%. So let us do the selling price here. Currently, the selling price is 20. So at 50% capacity, the selling price will fall by 5%. So 20 less 5% that means the selling price here would be 90. At 90% capacity, the selling price falls by 5%, accompanied by a similar fall in the prices of raw material. So the selling price, I'm so sorry, this is 3%. No, so for 90% it is going to be 19, and here it will be 20 less 3%. So that's going to be 19.4. Right? This is the selling price per unit. Material cost will be the same at 40% and 50%, which is 10, 10. And material price is going to fall by 5% when your production goes to 95. So this will be 9.5. Nothing has been mentioned about the labor cost, right? So labor, so estimate the profit. This at 90% selling price falls by 5%, accompanied similar fall in the prices of raw material. So labor cost, nothing has been mentioned. We assume it will remain the same. So this is 3, this is 3, and this is 3. Overheads, 5 rupees, of which 60% is fixed. So in this case, right, the total units that you're manufacturing is 10,000 into 5. So your total overheads are 50,000, out of which 60% are fixed. So 60% of this is going to give you 30,000, right? So out of 50,000, 30,000 are fixed. So variable overheads are going to be 20,000. Per unit variable overhead divided by number of units. So rupees 2 is going to be the variable overheads. So here I'll add the variable overheads, which is going to be 2, right? And now we'll calculate the contribution. So in this case, the total cost is 15. 15 minus selling price, 25 would be the contribution. In the second scenario, it will be 19.4 minus 15, that is 4.4. And in the third scenario, it will be 9.5 plus 3 plus 2, 14.5, and 19 is your selling price. So 4.5 would be your contribution per unit. Multiply it with the number of units. So the total contribution, in this case, it's going to be 50,000 because 10,000 units. In 4.4 multiplied by 12,500, that will give you 55,000 total contribution. I'm multiplying contribution per unit with the number of units. And then 4.5 multiplied by 22,500, that will give me 101,250, right? And from this I will subtract the fixed cost. Fixed cost we have calculated is 30,000, and therefore the profit under each scenario would be 20,000 in the current scenario, 25,000 in the next, and in that other one 71,250 would be the profit. So pretty easy questions here. All you need to understand is how to segregate the variable cost, calculate the BEP, calculate the contribution, etc. Going on to the next question. The sales turnover and the profit during the two periods are as follows. So sales 2 lakh, profit is 20,000, 3 lakhs, profit is 40,000. What would be the probable trading result with the sales of 1,80,000? What amount of sales will yield a profit of 50,000? Now, when you calculate the PV ratio, it's also calculated as change in profit upon change in sales into 100. Now in this scenario, the change in profit is 20,000, change in sales is 1 lakh rupees into 100. Therefore, your PV ratio is 20%, right? Now, you are being asked what would be the probable trading result if the sales with the sales of 1,80,000. Now we don't know the fixed cost, so we need to do a reverse calculation, but we have been able to calculate the PV ratio, which is change in profit upon change in sales. So going by this, so your sales figure for both are 2 lakhs, and 3 lakhs. PV ratio is 20%, right? So contribution will be 20% of this, which is 40,000, and 20% of this, which is 60,000. Now profit is given to us as 20,000 and 40,000. Now if you remember, profit is calculated as contribution minus fixed cost, right? So we have the contribution, we have the profit. So if you rearrange this, you will be able to calculate the fixed cost. Fixed cost in this case, in that would be contribution minus profit will give you the fixed cost, which will be 20,000. 20,000. Fixed is remain same irrespective of the volume, right? So this is very important. First, calculate the PV ratio using the formula change in profit upon change in sales. Calculate the total contribution, subtract the profit from the contribution to get the fixed cost. Now they have asked us what would be the trading results with the sales of 1,80,000. So contribution with the sales of 1,80,000 would be 1,80,000 into 20%. That is the PV ratio. So this would give you a contribution of 1,80,000 into 20%. That is 36,000, right? Less fixed cost, which we already calculated above as 20,000. Therefore, the profit earned under this scenario would be 16,000. Now they have asked us what should be the amount of sales to get a profit of 50,000. So sales should be, if you remember, it's fixed cost plus required profit upon the PV ratio. So in this case, the fixed cost we have already calculated as 20,000. Required profit is 50,000 divided by PV ratio of 20%. So this will give you 70,000 divided by 20%, that is, you will require to make a sales of 3,50,000 to earn a profit of 50,000 here. Going on to the next question. The following statement of Radical Co. for the month of June are given to you. Sales, two products, L and M. Variable cost, contribution, fixed cost, net income. You are required to compute the PV ratio for each product and then compute the PV ratio, break-even point and the net profit on the following assumptions. Sales revenue is divided as 60% of product L and 40% to product M. Sales revenue divided 40% to product L and 60% to product M. Also calculate the profit estimated on a sales up to 1,80,000 per month for each of the sales mix provided above. Now till now we've been looking at only one product. Now there are two products. So here, how do we calculate the BEP or the PV ratio? Now we have two products here, L and M. The sales is given to us as 60,000 and for both the cases, here I'm going to do another column with total. Variable cost 42,000. This is 60,000, right? So this will be 1,20,000. 42,000 and 30,000. This will be 72,000. So contribution here is already given to us 18,000 and 30,000. Total contribution is 48,000. So the PV ratio, which is calculated as contribution upon sales. So here it will be 18,000 divided by 60 into 100. Here it is going to be 30,000 divided by 60,000 into 100, and weighted average is going to be 48,000 divided by 1,20,000 into 100. So in this scenarios, let us calculate the PV ratio. So 18 by 60. Here you get a PV ratio of 30%. In the next scenario, you get a PV ratio of 50%. And the weighted average PV ratio would be 40%. 40%, right? Now what they have told us is that your the ratio of the sales should be divided as 60-40. Here the ratio is equal. 50% is L, 50% is M. So now let us recalculate it. L, M and the total. Now sales here is 60% of the sales is L. So 60% of 1,20,000, right? So 1,20,000, 60% is 72,000. 1,20,000 40% is 48,000, belongs to M. Total is going to be 1,20,000 itself. Sales, variable cost will change proportionately, or what we can do is, we can use the same variable cost, which is 72,000 is your total variable cost, since it is directly proportional. 72,000 variable cost, 72,000 into 60%. So that would be 43,200. Or else we can do a, what is the percentage? Sorry, here. My bad. So what I'm going to do is directly calculate the contribution here. Now in the earlier scenario, we had seen contribution. How much was the contribution for L? It is 30%. So 72 into 30% will give you the contribution, which is 21,600. For M, 48,000 into 50%, that will be 24,000. So the total contribution in this case would be 24,000 plus 21,600, that is 45,600, right? So your PV ratio here, it will be the same, that is 21,600 divided by 72,000, that is 30%, so on. But your weighted average PV ratio will change because the proportion is changing. So 45,600 divided by 1,20,000, right? So 45,600 divided by 1,20,000. So your weighted average PV ratio will go down to 38%, right? So this is what they have asked you to calculate. Compute the PV ratio. Now what will be the break-even point in this case? So break-even point, what is your total fixed cost? 36,000 is your total fixed cost. So BEP in this case would be 36,000 upon 38%. So here you will get 36,000. You will require to make a sales of 94,737 rupees to break even. So PV ratio, break even point, and net profit will be calculated. Now if net profit, let us calculate. Total contribution, your sales is 1,20,000. Contribution is given to, we have calculated here as 45,600, right? 45,600. Fixed cost is 36,000. Therefore 9,600 would be your profit. This would be your profit, where contribution minus fixed cost gives you the profit, right? So similar working can be done for a sales revenue, where the ratio is now changing to 40-60. So L is 40, M is 60, total will be 1,20,000, right? So 40% of 1,20,000 is 48,000. 60% will be 72,000, right? Same thing, now it has become reverse. 30%, this is your sales. Contribution we had calculated earlier, 30%. So 48 into 30%. 18,240, right? 72,000 into 50%, 36,000. Total contribution will be 54,240. PV ratio will be calculated as 54,250 upon 1,20,000 into 100. This is the weighted average, right? So that will be 45.2%. BEP, fixed cost is 36,000 divided by 45.2%, which will give you 79,646, and profit would be, your contribution is how much? 54,250 minus 36,000, that will give you 8 18,250, right? So if you're manufacturing multiple products, if the proportion changes, then that will also change your BEP, that will also change your profitability, that will also change the weighted average PV ratio. Going on to the next. The following particulars are extracted from the records of a company per unit. So product A and product B. Sales, consumption of material, material cost, direct wages, direct expenses, machine hours used, overhead expenses, fixed and variable are given to us. Comment on direct wages per hour is 5 rupees. Comment on the profitability of each product. Both use the same raw material. When total sales potential in units is limited, total sales potential in value is limited, raw material is in short supply, production capacity in terms of machine hours is a limiting factor. Now let us quickly calculate here for A and B. What is the selling price is 100, right? Selling price is 100 and 120. Material cost, direct wages, direct expenses. So 10 plus 15, 25 plus 5, 30. So variable cost here is 30. In this case, it is 25 plus 6, 31. So contribution is going to be 70 and 9, 1. 79, right? This is the contribution. So, 120 minus 79, so 41, so my bad. Yeah, 79. 89, sorry. Going ahead, let us calculate. This is the PV ratio. 70 upon 100 and 89 upon 120. So, in this case, the PV ratio, okay, this is material cost, consumption of material. Material cost 10, direct wages cost 15, direct expenses correct. So what we have been doing is correct. It's a selling price A and B. This is 100. This is 120. Variable cost here. We also need to consider the variable cost of 15 and 20. So this is 30. This is 31. Right? So 31, 30 plus 15, 45, and 31 plus 20, 51. Therefore, contribution is going to be 100 minus 45, that is 55, and 120 minus 51, that is 69. So PV ratio here would be 55 upon 100. Contribution upon selling price into 100. Here 69 upon 120 into 100. So PV ratio in the first situation would be 55%. In the second scenario, 69 divided by 120, it will give you 57.5%. So if the total sales potential is limited, then it is better to manufacture B because the PV ratio is higher. If the sales potential in value is limited, in that case also it is better to manufacture B because the PV ratio is higher for B limb. Now coming to, if you have a raw material shortage, right? So raw material required for A is going to be 2 kgs, because the cost of raw material is given to this is 2 kgs it's required, right? So A and B, kgs required, here 2 kgs and here 3 kgs. Now when you're using 2 kgs, you're earning a contribution of 55, right? Here you're earning a contribution of 55. When you're using 3 kgs of raw material, you're earning a contribution of 69. So per kg contribution will be 55 is earned when you're using 2 kgs, right? So it will be 27.5. In this case, 69 rupees are earned when you're using 3 kgs. So here it will be 23. So per kg you are earning more when you are manufacturing A. So if raw material is in short supply, it is better to manufacture A. Now limiting factor is where there is a shortage of that particular resource. So in that case, if the labor hours or the machine hours is a limiting factor, right? How many machine hours are required? Again, for A you require 3, for B you require 2 hours, machine hours. Contribution earned here is 55, here it is 69. So per machine hour you will get 55 upon 3, that is 20.33, 18.33, and here 69 upon 2, so 4.5. So the contribution here for B is more per machine hour. So it is better to manufacture B if the machine hours is going to be the limiting factor. Thank you so much.